diving into one of the biggest and, frankly, most audacious bets in the history of tech, Meta's colossal $135 billion pivot to artificial intelligence.
So, here's the billion-dollar question, or in this case, the $100 billion question. For any investor looking at Meta, this is everything. Is this spending a stroke of genius, or is it a reckless gamble that's going to incinerate shareholder value? Let's break down both sides of the argument, starting with the bulls.
Okay, so if you're bullish on Meta, your argument starts with the core business. You have to appreciate the sheer, unstoppable power of this thing. It's not just a company, it's a cash-generating empire.
Just look at that number, $115.8 billion. That's not revenue. That's the raw cash its operations spit out in 2025 alone. This right here, this is the fuel for everything.
And here's where that fuel comes from. $102 billion in operating profit, just from the family of apps. We're talking Facebook, Instagram, WhatsApp. It is a wildly profitable advertising machine that is the envy of the entire tech world.
So what's feeding that machine? People. Almost 3.6 billion of them using these apps every single day. That is nearly half the planet. That scale gives Meta an unbelievable data set and a direct pipeline to consumers, which, as you can imagine, is absolutely critical for their AI ambitions.
And all of this generates what investors live and die by, free cash flow. In Meta's case, it's not just the lifeblood of the business, it's a tidal wave of cash. It's a financial superpower that allows them to fund this enormous bet on building an AI moat that nobody can get across.
So from the bull's perspective, this isn't just about spending money. It's a calculated, strategic weapon. Zuckerberg is playing to the company's biggest strength, that insane cash flow, to try and dominate the next decade of technology.
All right, but for every bull, there's a bear. And the bears, well, they see this very, very differently. They look at that same mountain of cash and see a giant furnace just burning through shareholder value with no clear return in sight.
And this table tells you everything you need to know about the bear case. It is literally a tale of two companies. On one hand, you have the family of apps just printing money, and on the other, you have Reality Labs, which is basically a black hole that lost over $19 billion in a single year.
But here's where the problem gets much bigger. The skeptics will tell you the issue isn't just the Reality Labs loss. It's the new capital expenditure plan. We call it CAPEX. That's the money being spent on data centers and chips. That projected $135 billion spend for 2026 is set to burn through more cash than the entire profit of the core business.
And you know, this isn't some new problem. It's a trend, and it is heading in the wrong direction. Reality Labs' losses have more than quadrupled in just 6 years. And what's really concerning for the bears is that management themselves have warned that 2026 will be the worst year yet. They say it will peak.
And the spending isn't the only headache. Skeptics point to a perfect storm of external threats. You've got new regulations in the EU that are going to hit the ad model. And, critically, there's a tidal wave of youth safety litigation that some analysts are calling asbestos level in its potential financial impact. Even Meta itself has warned investors about it.
So this all brings us to the ultimate question for an investor. With this incredible cash machine on one side and this massive burn rate and risk on the other, is the stock's current price a bargain, or is it a trap?
Let's put Meta head-to-head with its biggest rival, Alphabet. Looking at how the market values these two giants tells two completely different stories about what the future might hold.
If we look at the forward price-to-earnings ratio, you can see Meta is trading at a discount, not just to Alphabet, but to the broader tech sector. Now, a bull looks at that and sees a huge opportunity. A bear looks at that and sees a giant red flag.
So the bull's argument is pretty simple. The market is being way too pessimistic. They say you're getting a company growing revenue at over 20%, but for a cheaper price than its main competitor. That gap, that discount, is what investors call a margin of safety.
But the skeptic completely disagrees. They'd argue Alphabet's premium valuation is totally justified. You're paying more for quality. You're paying for a company with a more disciplined spending strategy and, crucially, far less exposure to the kind of existential lawsuits Meta is facing.
So who's right? There's no easy answer. But the entire debate really boils down to a few critical factors that every single investor needs to be watching like a hawk.
So here's the core conflict. The bulls see a fortress, an AI moat being built. The bears see shareholder value being lit on fire. And the central dilemma for any investor is whether the price today properly compensates you for taking on that huge amount of risk. So here's what to watch.
First, is there a clear return on that massive capital spending? Do the Reality Labs losses actually peak, like they promised? How does European revenue per user hold up under the new regulations? And maybe the biggest of all, what happens in those youth safety trials? These are the variables that will decide who wins this debate.
The answer to this question won't just define Meta's future. Given its scale and influence, it could very well define the next chapter of our entire digital world.